Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions featuring the proprietary bull-bear point and figure market breadth summary chart for April 30th, 2017. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.51 rose from 1.33 last week, advancing within bullish territory. The total count of securities in bullish or bearish patterns decreased 5% to 3,150. The count of bearish stocks decreased 3%, while the count of stocks in bullish patterns increased 10%. The Pirls P&F Market Breadth Summary Chart shows us a market now 24 weeks in bullish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe to the weekly Pirls Stock Market Commentary via email free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 193 points for the fifth advance in 17 weeks. At a positive 120.81 points, it continues below all six tops above plus 100 and continues above all five bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Now at a positive 166.18, up strongly from a positive 101.36 last week. The CCI 20 daily uptrend continues. We wait for the CCI 20 daily to return to the plus or minus 50 range for a valid zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 52 weeks ago, while the daily CCI 20 began a Woody's uptrend 23 weeks ago. The CCI 20 weekly has risen to a positive 124.62 from a positive 76.99 last week. We await the return of the CCI 20 weekly to the plus or minus 50 range for another potential simulated trade. Industry rotation, the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: brokers, S&P retail, and some tech on top. Gold and silver, oil services, REITs, and some tech on the bottom. Bullish, gold and silver has entered the bottom 5. Oil services continues in the bottom 5. Brokers, S&P retail, semis, and comp tech have entered the top 5. KBW Bank has left the bottom 5. Bearish, REITs have left the top 5 and entered the bottom 5. Computer hardware has entered the bottom 5. Oil has left the bottom 5. Focus this week from www.zerohedge.com. Hedge fund CIO. What central banks have done is stunning, unprecedented. From Eric Peters of One River Asset Management, why what central banks are trying to do is impossible, why the trend of inflation over the past 70 years is stunning and unprecedented, and why volatility suppression always eventually fails. For all of history prior to 1955, there was roughly equal probability of inflation or deflation in any given year, said the economic historian. But since 1955, we've experienced uninterrupted annual inflation. It's a stunning fact, unprecedented. To an economist in 1955, the coming 60-year inflation would have appeared less probable than a catastrophic meteor impact. After enduring a series of world wars and social upheavals, policymakers conducted an experiment, removing the deflationary left tail of our economic cycles. We created history's greatest volatility-suppressing machine, and it delivered breathtaking stability. Of course, we endured volatile periods since 1955, but life is short, and we thus lack the reference points to compare our minor wobbles to the wild booms and busts of our great-grandparents. Minsky taught us that stability begets instability, and it stands to reason that our volatility-selling machine will break one day. We saw a glimpse of this in 2008 and 9. Perhaps the only thing more surprising than the severity of that crisis was the response of our body politic. In 2007, if you had shown the top 100 economists a list of the extraordinary measures that central banking and economic elites would unleash in the coming decade, not a single one would have believed you. Politicians hate change. With very few exceptions, they stand for stasis. Our central bankers seek stability, and investors have learned to front-run them all, selling volatility into every spike using ever more complex strategies. But volatility suppression at the lows is much easier in many ways than at the highs. In a crisis, our central banks simply go full throttle. At the highs, though, they seek the unattainable, which is perfect economic balance in a world that is inherently unstable. They attempt to crystallize the entire ecosystem, which is as arrogant as it is impossible. And this is what central planning looks like visually. Thank you for watching this week's Sand to Pearls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant, relaxing weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.